Hi, everybody, and welcome to Chapter 20 on Master Budgets and Planning. And here we're going to look at why we do budgeting. What are the benefits? Also, we're going to look at preparing a direct labor budget for a service firm and analyze revenue per employee. Most of you have had some work experience and may have already been exposed to some budgeting. And here we'll delve into the benefits of why we do that in a more sophisticated way. And first of all, we're going to prepare the operating budgets of a master budget for a manufacturing company. And you will see that that process is fairly sophisticated. Then we're going to take a look at preparing a cash budget for a manufacturing company, where we pull all those operating budgets together and forecast a cash budget. And then we'll prepare the budgeted financial statements based on those budgets. We sometimes call those pro forma financial statements. And then finally, we'll prepare each component of a master budget for a merchandising company. And you'll find that in Appendix 20 Alpha. All right, let's take a look at the benefits of budgeting. Here is a little illustration of how we develop a budget. We'll compare our actuals that we have to that budget, and then maybe do some action to fix some of the identified problems. Then we set new plans and we go through the process again. Budgeting then is a process of planning future business actions and expressing them as formal plans. The budget is a formal statement of the company's plans in dollars. And the budgetary control process then is management's use of those budgets to see that the planned objectives are in fact met. Okay. So here in the green oval are our benefits of budgeting. The plan focuses on future opportunities and, for that matter, threats. We motivate employees, done properly. The budgeting performance level provides goals for employees to attain or exceed, and provides direction so all our employees are walking in a direction that achieves those intended goals. We can communicate management's specific action plans to all employees through that budget. We can coordinate activities of all our employees and departments to do work towards the company's overall goals. And lastly, we have control. Provides a benchmark for evaluating performance and how employees are in fact achieving the goals that we have. Okay, budgeting and human behavior can be quite, call it, tricky. Budgets do provide a motivating force when, one, the goals reflected in the budget are challenging but attainable. The employees affected by the budget help prepare it. And evaluations offer opportunities to explain differences between actual and budgeted amounts. I can remember quite well when I was but a young man of about 15 or 16, and one of my first jobs was on the Key Man Council for the Broadway stores, which was a glorified sales clerk. And so I can remember we shut down the entire store. We brought in some senior managers from corporate office, and basically they said, your goal for next year is a 5% improvement. They didn't tell us anything as to how we could achieve that. They made little presentations, but how am I supposed to achieve a 5% growth rate? I mean, I always tried my best to sell the most I could, but that was a useless and waste of time. And when you have potential negative outcomes, here we have pressure to meet results, the employees to engage in unethical behavior or commit fraud. I don't think the Broadways did that, but they didn't give us any ideas to how to achieve that 5% or how that might affect my upward potential in the company. The employees, number two, the employees might understate sales budget and overstate expense budgets to provide a cushion. We sometimes call that uh, sandbagging. And then number three, the employees here might spend budgets on unnecessary items to ensure that the budget is not reduced for the next period. I've seen all of those negative outcomes, and that's just um, an example of what happens when you don't do budgeting correctly. And when I was in charge and could do budgeting correctly, I worked really hard to do that in a way that was positive and motivating. It takes a lot more work to do that, a lot more work, but it's well worth it. Okay, budget reporting and timing. Here, in the first bullet point, continuous budgeting applied by preparing rolling budgets. Now, a rolling budget would be one where let's say we go 2 or 3 months and then we redo the budget and roll it forward based on better data. We can continually revise budgets as time passes. And number three, bullet point, rolling budget. A company revises an entire set of budgets by adding new quarterly budget to replace the quarter that just elapsed. As a practical measure, that involves a lot of time. So a rolling budget is appropriate if in fact there have been some major changes. But as a practical measure, most companies do a budget yearly. All right, let's take a look at the operating budgets of a master budget for a manufacturing company. I've spent my career in manufacturing companies, and this is an old friend to me. So first of all, we're going to do the sales budget. Now, we'll get into this a little bit more, but the sales budget is critical. If the sales budget is wrong, everything else is wrong because everything spins off that sales budget. So human behavior being what it is, when I was in charge, I evaluated my salespeople by how well they produced their budget. And $1 too low or $1 too high were measured the same way. So oftentimes you might have salespeople that are sandbagging. In other words, coming up with sales forecasts that are on the low side. Now, that's just as bad as sales forecasts on the high side. We want the sales budget to be as accurate as possible. So my evaluation of salespeople budgeting was that $1 high or $1 low were no different. So we wanted to try to get an accurate budget. And from the sales budget then, the production people figure out how much direct labor, how much overhead, how much materials they need to produce those sales. And as you can see, they calculate these three aspects of production costs. And now we also may need to purchase some machines to make those products, in which event we need some capital expenditures on those machines and other equipment that we might need. Also, we want to have an appropriate level of selling expenses as well as general and administrative expenses. all based on what we think that sales forecast is going to be. And all that comes together in our cash forecast. So that's what we call a financing budget. This capital expenditure are investing budgets, and our operating budgets are shown in Accrue here. Sales, production, direct materials, direct labor, and factory overhead. Just like our statement of cash flow is organized into those three operating activities. Okay, so let's take a look at a balance sheet. Here is that balance sheet, and we have our typical assets, liabilities, and equity items on that balance sheet. It noted here that equipment's depreciated on a straight line basis over 10 years with a salvage value of $20,000. Okay. Now, here's the sales budget. We're making hockey sticks. So Toronto Sticks Company sells 700 hockey sticks at $60 each, and it prepared the following sales budget for the next 3 months. So you can see there's quite a difference in how many we sell in each month. The budgeted sales units for October is 1,000, but it falls off in November, but comes back in a vengeance in December. And so our budgeted sales dollars are quite a little bit different per month, but in total we have $192,000 in sales for that quarter. Now, the manufacturer prepares a production budget, which is going to show the number of units to be produced in a period. So that production budget, of course, is based on the unit sales projected in the sales budget, along with, of course, inventory considerations. So the units that we're going to produce here are going to equal the budgeted ending inventory units plus the budgeted sales units. But we already have beginning finished goods, so we subtract those. So a production budget does not show costs, as it's always expressed in units of product. Okay. Now, the production budget is based on unit sales, projected sales budget, along with inventory considerations. So here is our sales, right? We add the ending desired budgeted sales, and we want that to be 10% of the next next month's unit sales. So you can see the next month's budgeted sales units was here, and we want the ratio to inventory to future sales to be 90%. So we take 90% of the next month's budgeted sales, which in October is 720, and then that becomes the next month's beginning inventory units. Okay, so that tells us then our required units to be produced here, and then we back out the beginning units, which we already have, and that tells us the number of units that we need to produce. Now, from a sales budget, then we're going to assume 900. Now, this is a bit theoretical in that we probably would smooth this out a little bit as a practical measure rather than lay off our workforce and bring them back on. That looks like a good place for us to stop this video. And when we return, we'll take a look at computing materials to be purchased. Until that time, bye for now.